Dave Seymour here. Today I have something that could change your entire perspective on the economy, the future, and where you should put your money. But we'll get to that in a minute. One of the most respected voices in finance, David Hunter, just made a startling prediction. He's warning us that the US dollar is on the brink of a significant downturn. This could expose major vulnerabilities in our financial system. In a recent statement, Hunter didn't hold back. He said, the prolonged period of dollar strength is coming to an end, and the repercussions could be severe for the US economy. I'll give you a moment to absorb that point. This isn't just a passing comment, it's a wake-up call. Now, if you don't know who he is, David Hunter is a 50-year Wall Street veteran who is known for his eerily accurate forecasts. He's correctly predicted the S&P 500 would reach 4,200 to 4,500 within a year after a short-lived drop. It did reach those levels in May through October of 2021. He also accurately predicted most of the major peaks and bubbles of the last 4 decades, and even predicted the rise of Nvidia. Right now, he writes a newsletter called The Contrarian Value Advisor. He's someone you should listen to. So, I don't know about you, but when a seasoned expert like Hunter predicts a massive shift, I sit up and take notice, and frankly, I don't like the sound of what he's saying. In today's video, we're going to break down exactly what Hunter is forecasting. I'll explain how we got here, and what it means for your bank account, and most importantly, what you could do to protect yourself and even benefit from these changes. But before we dive in, I need a quick favor. If you haven't already, hit the like button and subscribe to the channel. Look, it might seem small, but it makes a huge difference in spreading this information to those who need it most. You got it? Good. Look, we're navigating precarious times here in America. It's clear that we can't rely on the government or the elites to safeguard our interests. It's up to us to stay informed and proactive. I'm here to help you do just that. Let's get started. Let's discuss what's happening in the broader market and, more importantly, the debt-based monetary system. We're seeing a flight away from it towards tangible assets like gold. Now, these assets hedge against the systemic risks in our current financial system. Let's discuss why the US dollar is pivotal to risk assets and how it's starting to roll over. A declining dollar trend to benefit tangible assets, and we've got a lot to unpack here. Let's dive into it. The wealthy understand the importance of owning tangible assets, while the poor often don't. That's why the top 1% grow their wealth with the money supply, while the rest diminish against it. We want to help people escape this trap. By understanding the macroeconomic environment, you can secure a stable and growing income stream insulated from the volatility of traditional financial markets. Dave Hunter argues that the US dollar is rolling over and just beginning its next leg down after a 17-month sideways consolidation. His downside target is around 80 for the US dollar index. He sees currencies like the euro, yen, pound, Canadian dollar, and Australian dollar positioned for significant upside versus the US dollar, with rates also rolling over, potentially leading to a market melt up. The dollar's been in an ascending channel since 2008, when we officially entered a period of central bank interventionism and bailouts. The bailouts in 2008 were around $500 to $600 billion, but today we're printing trillions of dollars. This calls the sustainability of the current monetary system into question. Tangible assets, on the other hand, well, they offer a more resilient investment option. They provide essential value and generate income regardless of the dollar's performance. Tangible assets tend to do well as the dollar rolls over. OPEC's decision to increase oil supply could put downward pressure on oil prices, contributing to a weaker dollar and benefiting real estate. The demand for tangible assets remains strong, and investors can capitalize on this consistent demand. Deflation is emerging, with core inflation in Japan and the Eurozone falling back towards deflation territory, reversing the previous monetary inflation. This deflationary pressure increases the attractiveness of real asset investments, as they provide a stable income in a low-growth environment. There are signs tangible assets are moving in a positive direction. Investor Stan Druckenmiller's move from tech stocks to more stable assets signals this expectation of lower rates and better environment for tangible assets. By following this strategy and investing in real assets, you can align yourself with a proven wealth preservation and growth approach. The Fed quietly admits that gold is replacing the dollar as the monetary system faces potential collapse. Central banks are accumulating gold rapidly as a shift from the dollar system accelerates. Similarly, institutional investors are increasing their allocations to tangible assets to hedge against currency debasement and economic instability. There's a lot going on, isn't there? To make matters worse, the FDIC reported that 63 banks are on the brink of insolvency, with $57 billion in unrealized losses in Q1 of 2024. Now, this suggests more bailouts and money printing are coming, which could further debase the dollar. Tangible assets hedge against this monetary expansion, offering a tangible asset that retains value even in the currency weakness, we could say. There are also reports that Saudi Arabia may wait to renew the long-standing petrodollar agreement with the US when it expires on June 9th, which could blow the dollar's status as the global reserve currency. This shift could lead to significant changes in international capital flow, with more investors seeking stability and income potential for tangible assets. The mounting debt, potential dollar weakness, and the shift towards alternative assets like gold indicates significant problems and imbalances in the US economy and financial system. A continued debasement of the dollar could lead to a significant repricing of risk assets. Investing in tangible assets can protect your wealth and benefit from those resilient assets' income and appreciation potential. Real assets are not just an investment in stability, they're an investment in value that persists regardless of market condition. This demand is not going away, it's growing as more people look for secure options in uncertain times. These assets offer stable returns, tax advantages, and the potential for significant appreciation, making them a smarter choice, some would say, for long-term investors. Here's a prime example. Many traditional investments plummeted during 2008's financial crisis. However, tangible assets like gold, well, they continued to hold value. Investors still needed a hedge against inflation and economic instability, and that didn't change despite the broader financial turmoil. The stability is why tangible assets could be a cornerstone in any diversified investment portfolio. The beauty of tangible assets lies in their ability to provide security and stability. Even if one market segment struggles, you still have value in these assets. Diversifying within a single asset class reduces risk and provides more stable returns. Moreover, tangible assets benefit from the economies of scale. Now, most experts will tell you that gold or bonds are the answer. Well, they're wrong. Real estate is the answer, but not fixing and flipping single-family houses. Way too much work. I eventually moved into an alternative asset class that was not easily accessible to the public at that time: multifamily properties, specifically cash-flowing multifamily apartments in high-growth areas around the country. Now, these private equity investments were reserved for the rich until recently. Well, now anyone can grow their income portfolio and wealth with tangible, appreciating, future-oriented private real estate assets. Professionals who make good money but don't want to get involved in finding and managing these deals, well, they can even invest passively. They can invest in a private real estate fund that builds, buys, and lends to multifamily real estate projects throughout the country. And by doing so, they can generate the cash flow, increase their net worth, and also enjoy tax advantages not available through any other investment vehicle. Every multifamily apartment offers multiple streams of income. Each apartment unit is like a little cash flow stream, if you will, coming in every month. And in right locations, these investments appreciate in value over time. Well, that's why we look for properties in cities and submarkets where we expect outsized rent growth and investment demand. And we make certain as possible as we can that we have those advantages on our side. And to do that, we rely on our boots on the ground. These are relationships that we've built over time with agents, brokers, banks, and other players that can give us a real scoop, if you will, about what's going on in a particular area. If you have questions or comments about investing in these kinds of alternative assets, go ahead and post them below. I'll share more information and strategies on this channel. And if you found this video interesting, please press the like button. This way you'll get to see more videos on this topic. Oh, and don't forget to subscribe to the channel so that you can get notified when new videos get posted. For Legacy Alliance, I'm Dave Seymour. I'll see you on the next one.